Hi, I'm Pattu from freefincal, and a couple of days ago I released the equity mutual fund outperformance screener for April 2019. You can get the screener from the link in the description box for rupees 111. From this month, the screener will not be available for free because of the change in freefincal usage policy. Too many people have misused my sheets and have taken it for granted, and I'm not going to put up with this. Please recognize that the sheets are nominally priced. It's just 100 rupees plus 11 rupees for the transaction portal. I'm not going to make millions from this. It's just going to help me pay a couple of expenses here and there for hosting the website and for creating the sheet and for the data usage, etc. So I have introduced a new screen this month. This is called excess return and excess risk screener. So I'm going to talk to you about how to use this screener. So if you go to the risk return screener tab of the file, so if you get the file, you will have a zip folder. Inside the zip there will be two files. One is a macro screener and one will be just the data. The data you can upload anywhere, maybe on a spreadsheet. You can use in OpenOffice or LibreOffice or whatever, and then use it the way you want. The macro screener will only work only in Excel, and you need to have macros enabled. But for this sheet, the risk return screener, there's no macro involved, but I'll show you how to use it. So let me go through the categories. First is the category the fund belongs to, the benchmark. You can sort using, you just sort them using categories. So balanced advantage funds, and then you have ELSS funds and so on. We have the benchmarks used for comparison. Then that's the fund name. So this red sentence is just telling you how to screen. Filter funds with excess return, that is greater than 0, and excess risk, which is less than 0. I'll explain what it means. So the first column will be the return of the fund in the last 1 year. The return of the benchmark in the last 1 year, the return of the fund in the last 1 year, and then the excess return of the fund. That is, if the fund has bet the benchmark in the last 1 year, then the excess return of the fund will be positive. So for example, here the benchmark is 2%, the fund is only about 0%, so the excess return is negative. So that means the fund has not bet the benchmark. So the thing that you should do is to look for excess returns which are greater than 0. That means the fund has bet the benchmark. Then I have the index standard deviation for the last 1 year, that is the volatility. Then the fund standard deviation for the last 1 year, and then this is the excess risk. So if the fund has exhibited a risk which is greater than the index, then the excess risk will be positive. That is, if the fund standard deviation is greater than the index standard deviation, then the excess risk will be positive. So how do you screen this? So this is for 1 year. Then you have the pink colored column for all 2 years, blue for all 3 years, last 3 years, the violet for last 4 years, and the brown for last 5 years. So what we'll do is, first I'm going to screen for excess return greater than 0. That's the first screen. Then I'm going to look for excess risk which is less than 0. So I want funds with excess return than the benchmark, but the risk should be lower than the benchmark. So that is why the excess risk is negative. When the excess risk is negative, that means there is no excess risk, and actually the fund has got a lower risk than the benchmark. Maybe the lingo is a bit confusing. If you want, I can change it for the next time, but I think it should be okay if you get used to it. So now we have done this initial screening over the last 5 years. So if you now count the number of funds, we started with about 262 funds, I think. Some funds, 1 or 2 funds may be repeated again. So 262 funds are unique. So out of that, if I just look for funds in the last 5 years, they should have bet the index, got higher return at lower risk, then I have only 71 funds. That itself is a big reduction in the number of funds. You can impose the same filter for 4 years, or you can do it for 3 years. It's up to you. Let me just do it for 3 years. You can ask for 3, 4 and 5 years. That also is fine. So again, excess return should be greater than 0 and excess risk should be less than 0, that is there should not be any excess risk, and that's it. So now you can see, if I count it down, it should have gone down to about 30 or so, I think. Yeah, so we have about 31 funds, which is a short enough sample. Remember, this is not 31 funds in one category, this is 31 funds across all categories. So that should give you a good enough short list. Now you can go here and let us say you're looking for a tax saving fund. You can just go here. Of course, I'm doing this in Mac Excel. Windows Excel, the look and feel will be a little different, but the essential is the same. So I'm just going to shortlist ELSS funds. Those are the 3 ELSS funds that have produced excess return over the last 3 and 5 years and risk lower than the index over 3 and 5 years. So you can shortlist funds like this. This is, of course, please recognize this is only one data point. Last 3 years, last 4 years, last 5 years, last 1 year, last 2 years. If you want over all possible last 3 years, 4 years, 5 years, I have not included the standard deviation calculation as of now into the screener. I will try and do it next time. But the usual screener outputs have something called as downside protection. So if you go to the main screener input, then there is a results tab. I'll explain what it is. Let me first clear all the filters. So this is a different screen. Again, I have the category, the benchmark, and the fund. And now I have, we are going to look at the performance of the fund over every possible 1 year period in the past. So we are looking at, let me just make this a little bit bigger so that it's easy for you to see. So we are looking at 2,951 1-year returns in the past of the index, the same number of returns for the fund, and out of those 2951 returns, the fund has bet the index 1739 times. That is, 1739 divided by 2951 is 59% rolling return outperformance consistency. Then over every possible 1 year period, we look at monthly returns and we find out when the index moved up, did the fund move up higher than the index or lower than the index? So the fund has typically moved higher than the index with 42% consistency, but don't worry about upside performance consistency too much. It's not so important. What is more important is something called downside protection. That is, during those every possible 1 year periods, when we look at monthly returns, when the index gave a negative return, did the fund fall more than the index or less than the index? So the fund fell less than the index with 81% consistency. So that's pretty decent, right? So this is, so all the orange columns are for 1 year. The similar entries are there for in blue columns for 2 years, green columns for 3 years, violet columns for 4 years, and brown columns for 5 years. So you can now automate this. Now I'm going to say that I want return outperformance consistency to be 70% or more over 5 years. We'll go back again, 4 years and 3 years. Then I want downside protection. That is, the fund should fall less than the index at least 70% of the time or more over 5 years, over 4 years, over 3 years. And that should give me a decent number of funds. Let me just find out how many funds are there. If you go to the 5 years is there, right? So that's it. So let me see how many such funds. So again, there are about 262 unique funds. Couple of funds are repeated. I'll try and get rid of them next time. So that's about 50 funds exactly. That's not bad at all. So that's a good enough short list. To me, that's a good enough short list. Now I will go here and I will select the category again. So I'll say I'll unselect all of them, choose ELSS, and that's it. So now I have 1, 2, 3, 4, 6 funds, right? Now if I go to the excess return and low risk screener, there are like 3 funds: Aditya Birla Invesco Tax Plan, Kotak Tax Saver. You can see that Aditya Birla is here, Invesco Tax Saver, but Kotak is not here. So I will not worry about Kotak's Tax Saver because it has not been consistent. This performance is not consistent. At least these 2 funds are good. But I can choose among any of them because this is a much more rigorous way of screening. I can choose among any of them if you are interested in good downside protection and return consistency. Of course, this please recognize that this list will keep changing from month to month, or if every 6 months to 1 year and so on. You cannot expect to be invested in the best fund and so on. Of course, this is one way of screening funds. So please recognize, use the screener not to check the performance of your funds, but use it to pick a new fund. That will help you. So please give the screener a try if you're interested. The purchase link is down below. Other details about the screener are also found in the description link. Please do have a look at it, and I'll catch you in another video. Thank you for listening. Bye-bye.